All right, so assuming you're coming here straight from our part 2 of our cash secured put series, we're going to jump right back into it with part 2.5. We'll call it part 2 of our picking the stock video. So getting back to our basic principles, we're going to pick right back up on the third bullet point where we talk about avoiding stocks in risky industries with bankruptcy issues. So what happens to shareholders in bankruptcy? The answer is it's uncertain. To illustrate this point, we're going to look back at one of the most economically similar times to what we're currently experiencing, which is the 2008 financial crisis. So as a lot of you are probably aware, there was a huge housing crisis back in 2008 that caused all sorts of volatility and uncertainty in the market. And automakers were some of the hardest hit companies during this crisis. The big three, GM, Chrysler, and Ford, were all facing potential bankruptcy. And they were trying to figure out how to navigate around that at a time when no banks were lending because there really wasn't a lot of trust in financial institutions. Some of the bigger banks were going under. So let's look at what happened to some of those companies. Well, for General Motors, they actually wiped out all their stakeholders. So if you kind of look through here, what happened was that they owed a bunch of money and could not repay that. So they took a bailout from the US government. And as part of that bailout agreement, they had to undertake a 1-for-100 reverse stock split to make it back to the market. And the result of that is that all shareholders who currently held stock, essentially, their stock was worth 1% of what it used to be worth, and they were effectively wiped out entirely by the bailout that they had to accept in order to keep their business going. So if you look at the stock market today, you might see GM as a ticker on the market. You might look back and think, oh, well, they went through a bankruptcy process and they turned out okay. They're still on the stock market. Well, if you were an investor in 2007, that is not accurate. They actually had to go through this whole process where they wiped out current shareholders. There was a path back to the market for them that they took, but unfortunately, that path involved wiping people out. When we sell cash secured puts, we want to make sure that we don't put ourselves in a position where we could lose 100% of our investment. But let's look at kind of the flip side of this for Ford, which is they were kind of looking at the same issue of GM where they might have had to wipe out all their stakeholders, but they actually successfully executed a turnaround where all the stakeholders from 2008, 2009 were able to hold on to their stock, and they rebounded and they're still currently trading on the market today. But what this tells you is that when there's uncertainty like this in the market, really the result of potential bankruptcy is 50-50. You could have a successful turnaround like Ford, or you could have something happen to you like GM where all current stakeholders are wiped out. And if you're holding stock, that's pretty much a 100% loss on your investment. So if there's a 50-50 shot that you have a 100% loss on your investment, obviously the number is a little more complex than that, but the idea is that it could go either way. If a potential 100% loss on your investment is something that could be on the horizon, that's something we want to avoid when we sell cash secured puts, because the only way these can really go south is a steep drop from the stock, or if the stock is eventually worthless. So we want to avoid putting ourselves in a position where our stock could potentially be worthless. So avoid potential bankruptcies. The other point we wanted to hit on in this bullet point is to avoid stocks in risky industries. And for that, I'm primarily talking about biotech and other healthcare type fields, especially at a time like this where COVID is dominating the news. Potential vaccines or any vaccine or trial announcements are swinging stocks wildly all over the place. And to illustrate that, let's kind of take a look at a stock called Novavax, which is one of these that trades in the healthcare biotech category. This is just last November, less than a year ago. They were trading about $3, spiked up to $5, but the idea here is they were trading between $3 and about $5 at this time. So let's fast forward to today. This is the area we were just looking at, and this is back in August. The stock spiked all the way to $190 because they were named a big player in the COVID vaccine game, and all the hype that builds around that stock. It was a heavily shorted stock, and it shot all the way up to almost $200. So say something like this happened, you're like, okay, this is great. Like they could potentially have the cure to COVID. This is a company I want to invest in up here in this 160 to 180 range. And as you can tell by the volume, a lot of people did. Well, let's back out and look at it today, which you could probably see by the price ticker, but it dropped from 189 at the peak all the way down into the 80s, which is super fast. This is from August 4th to September 8th. So just over a month, it dropped from 189 down to 86. Big drops like this are something we really want to avoid because we do have strategies in place that help us recover when we take assignment on stock. But if a stock drops this quickly and is this out of control, we're going to lose a lot of our ability to make money on that stock back. So steep drops like this, this is essentially a 50 or 60% drop from the peak, this is something we want to avoid. And this is very common in biotech and healthcare fields. So primarily when we're selling cash secured puts, while they do offer solid premiums, this is a field we want to avoid due to the steep and volatile nature of the stocks that are within it. And you could look at something like Microsoft, which is a tech company, a strong company that we are a lot more bullish on long term, a lot stronger of a stock, one of the traditional blue chip stocks. You'll have big drops sometimes, like 230 down to 215. But if you back up and look at the past maybe 180 days, this is about the biggest, this 230 to 217 drop. This is about one of the biggest drops that it had. And while that probably would have hurt us in the short term, there's a nice slow churn right here, and it slowly recovered off the bottom of 197. And we have strategies in place where we would have recovered our initial investment. But if it had a similar drop to Novavax, a 50 to 60% drop, it would have dropped all the way down to 110, which we would literally have to zoom out on here to get all the way down to. It would have dropped down to here in a month, which is something we want to avoid. So when we sell cash secured puts, yeah, we want to kind of pick and choose our spots where IV is inflated and we can get good premium, but we do think it's important to look at the history of the stock and the price action so that you could put yourself in a situation where you're not going to have a huge 30, 40, or 50% drop over the course of a week, 2 weeks, or even a month that is just going to ruin any potential to recover the initial investment that you made in the stock. So with that said, we're going to get into our fourth and final bullet point on here, which is take areas of support into consideration. And to evaluate this point, we're going to jump right back into Thinkorswim. We're going to take a look at some technical analysis and see what kind of things we're looking for, what kind of tools we could use to evaluate a stock and find different areas of support. All right, so let's take a step back into the world of technical analysis. And I know we've said on our channel in the past that we're not huge on TA, but there are a few indicators that I think are pretty helpful. So that's kind of what we're going to look at. The first thing we're going to talk about real quick is just basic support and resistance. We've gone over this in our credit spread videos when we talk about picking strikes to set when you open a spread. And just the basic concept behind that is if you look at Apple's daily chart today, kind of right around 116 here, the price keeps bouncing up and off and up and off. This is known as support because it keeps hitting that price and bounces right back up. And if you bounce off support enough, you're eventually, as you can see what happened at the end of the day and kind of through after hours, you're going to kind of move away up in the other direction. So the whole idea when we set our credit spreads is that we would want to set a put spread down here since support gives us a little bit of help. But when we sell puts, we also want to take support into account. So if we were to sell puts, granted this is the one-day chart, we would look at this area that's 116 and say, okay, we're probably safe selling at a strike below 116 since we have this strong support here that's protecting us. The next thing I'm going to want to get into is called VWAP, which is volume weighted average price. So the way to pull this up on Thinkorswim is if you go to studies, go to add study, all studies, go down to the V's. It's going to be right here at the top. And as you can see, it puts 3 lines on the screen. And the idea is that all rises and falls in price aren't the same. If there's a rise, but there's not really a lot of buying volume and the price goes up, it's probably not that realistic that the price is going to stay up on that rise. And it goes likewise the other direction, where if the price is falling, but there's not a ton of selling volume, it's probably going to revert to the mean. So what this does is it takes the volume and the average price into account and kind of gives you 3 lines. This purple is the main trend line. And you can use this to kind of figure out where you would expect it to be between the top and the bottom. And as you can see what happened throughout the day, it kind of stayed within this range pretty well. So if it gets up towards the top trend line, you might say, okay, it's probably going to pull back here a little bit. And if it gets towards the bottom, which it didn't happen, probably likewise would happen, and you would think that it would go up. If we could pull up another stock real quick, like AMD. Good example right here. Got towards the bottom trend line, popped right back up towards the purple middle line that we've got right here. Now it's not perfectly all the way back up, but as you can see, it's kind of a good general guide about price action during the given day. For example, if we back this up to 5 days, your bottom right here was this yellow line at 86, but the next morning it opened up at 83. Now granted, that is because there was some company specific news, but you could look further back where the top line on Wednesday was about 87, and the next day it got all the way up to 88. So really what this is useful, not so much for long-term support and resistance, but if you're looking for an entry point throughout the day, if you wanted to sell a put and it's up here, you might say, okay, hold on, let me wait 1 second for it to pull back a little bit, and we'll get a better entry point right here. And going kind of along a similar vein as the entry point, we're going to pull up another study, which is, we're going to clear this one off first real quick. And this one is going to be called RSI, which is Relative Strength Index. So again, we're going to go to all studies. We're going to go down to R. and it's right at the top right here. And a great example is we're going to switch over to Peloton because this one worked very well on this today. So let's take a look at what happened with Peloton throughout the day. As you can see, it gets bought up. And what RSI, Relative Strength Index, does is it gives you a number between 0 and 100. Anything above 70 means the stock is overbought, and anything below 30 means the stock is oversold. So how would we use that throughout the day? So if you were at, let's say, what time of this? About 2 o'clock right here, and you were looking to get out of a position because it's running up against you, you might start panicking because it runs up from 120 to 122. But if we looked at the RSI, this is a great indicator right here. We'd see it's incredibly overbought. We stay patient. We wait for the fall back down to the low 121, and then we would exit our position back when RSI gets back to normal. So again, this is another one that is pretty good for entering and exiting positions. And throughout the day, entry is so important because the credits on these options that we sell can change in the blink of an eye. So entry and exit are incredibly important. So RSI and volume weighted average price are a great way to determine throughout the day when the best time to get into a put that you're selling is. And this applies to spreads also. So you could use this advice for both types of option selling that we use on this channel. All right, so let's put all that together and actually make a trade where we sell a put and pick a good strike price. So here we have the 5-day chart for Hyliion, which is an electric vehicle. It's a company in the electric vehicle space, which has had a huge downfall lately. It was up at 50 a couple weeks ago, so the implied volatility is huge off this drop. But we've got some indicators that tell us this kind of might be the end of the drop, and we might be able to cash in on that IV and get some good premium on puts we could sell. So where do we want to look first? Let's start with the basics with support. And you could actually kind of draw support here if you go to drawing tools and price level. So if we start here, it looks like there's pretty solid support. Let's see if we can get our mouse there. But right around 29.50, it was bouncing off that pretty much all day Friday, never dipped below it. And when it touched it, it bounced off pretty hard, touched it, bounced off pretty hard, touched it again at the end of the day, but then bounced off pretty nicely. We saw it bounce off that a little bit on Wednesday. Thursday was far above that, so we didn't have to worry about it. But 29.50 looks like a good point of support for us. Let's look at RSI next to kind of see what the relative strength of this is looking like. So we'll go back to our studies. We'll do a quick study down to the R's, and right at the top here, RSI. So we can see at some points during Friday, it did get a little bit oversold. So it bounced right back up off of that and kind of was mostly oversold when it got back around that 29.50 support. And you can see in the past, most of the times it's been oversold. It's shot back up, oversold, shot back up a little bit. And it's still relatively oversold. Obviously, it's not in the blue down here like we normally like to see it when we are anticipating a spike, but it's on the lower half of 50, so it's relatively oversold. And at the end of the day, when it was trading right around that 29.50 price level, it was right around 34 or 35. So we are kind of confident that it's going to bounce back off of that. So using that, we know that 29.50 is decent support. It's a little bit oversold right now. We think it's going to bounce. Let's be safe. Let's look at the low point on the stock here, 28.35, and let's put it below that. Let's sell 28 puts. And as you can see, when we go to the trade screen, we've already actually sold some 28 puts for next week. A premium of about $1.25, $1.20 here. As you can see, when you click on the trade screen, you can get anywhere between there. Sometimes with a spread this wide, you just have to play with the bid a little bit to get the price you want and just be patient. But that's what we were able to do. And those offer a 4.67 weekly return on risk. And we'll remember that a 4.67 weekly return on risk is something that compounds to a dumb number, a 973.39% annualized return. So while this is a little bit risky since it's dropped so much, IV's high, that potential almost 1,000% return we think justifies it. We've looked at some of our indicators. We think we finally have a nice base that we could bounce right back off of. So this is a trade that we're comfortable making. And even if it does continue to crash, we have a strike price of $28 minus a $1.20 credit means that we're going to be at $26.80 with our basis. So in reality here, let's draw another price level. As long as it doesn't drop below here, and we can, if you accidentally draw it too short like we just did, you can extend it to the left. As long as it doesn't drop below here, we're going to make money next week because we'll be able to roll those puts over for a profit. So that's the strategy we're going to go with. Hopefully it'll work out. We'll update you in a future video with how that went, but this is kind of the basis that we look at when we're making decisions, how we use technical analysis to guide us, and how we ultimately make the play. And with that, we are finally through part 2 of our cash secured put series. Took us 2 videos to get through part 2, but we finally made it. We get a question a lot about what happens if we are actually assigned on these puts that we sell, and we'll be addressing that in future videos, so stay on the lookout for that soon. In the meantime, subscribe to us on here and on our other social media accounts if you haven't yet. But that's all we got for now, so thanks for watching, and this has been the Hourglass Trader, where as time passes, we make money.